Now, it is true that no matter what one's political views are, debt's only going to go up higher, right? Doesn't matter if it's Trump or Kamala or Kennedy or some alien that suddenly decides to run for president that was born in the United States. And I mean, actual alien from out of this world. And as far as the parents go, like, it doesn't matter, right? The end result is you're going to have more debt, and the interest expenses only go higher. If we accept that that's a fact of our present life, then what is the implication? The implication is the U.S. government's going to need perpetually, as historically is the case, negative real interest rates, meaning inflation being higher than the cost of capital, than nominal rates, right? Because that's the only way you can erode the debt load is if
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today, we're fortunate to have with us Michael GAYED. Michael is a portfolio manager and an author of multiple award-winning research papers on market anomalies and investing. He's also a CFA charter holder and the founder of the Lead Lag Report. Michael, thank you so much for joining us today.
That's the kind of intro my mother would give, so I appreciate you copying that from her. Thank you.
No problem. Yeah, well, she and I had a little discourse here leading up to it. So.
Clearly.
All right. So, Michael, politically in the U.S., things are really heating up. They're getting much more volatile. There's been some significant events happening in the last 2 weeks, and there are likely more surprises coming. Geopolitically, there's also hotspots everywhere, and Secretary of State Antony Blinken recently stated that Iran is a week or two away from having nukes. These are just some of the political issues domestically and globally. There's many other issues as well. Are you anticipating a larger move towards safety for investors? You know, traditional assets such as Treasuries and gold. And can you elaborate on both classes, as Treasuries are significantly challenged right now for multiple reasons?
All right. So there's a lot to unpack there. Just prior to this conversation, we were talking about my own health journey, right? And I've been very public about my fasting and the weight loss I've gone through. And why do people gain weight and get unhealthy? Because of complacency, right? They're comfortable. Life's coasting along. You want to get that dopamine hit, so grab that muffin, grab that fried food, right? Don't think about restricting calories. Don't think about restricting time. Just eat. And that has all kinds of implications the more you're complacent about your health in terms of what happens long term. Because when you're complacent about your health, you're at risk of an event, cardiac or otherwise. Same applies to markets, right? I mean, to the extent that investors are complacent because of things that have been ongoing for some time that haven't mattered, and because they haven't mattered, it reinforces the complacency even further. At some point, there's an event that shocks the complacency out of the system. I think that aside from Iran, aside from Japan, there's a lot of things that investors are complacent about. They're extrapolating a lot of the most recent past into the future, assuming that the future looks like the past, and it's never exactly that easy. So, yes, I do think that there are a lot of potential tail risks out there, which, although they are known, they are not being priced in yet. Right now, the question about sort of safety, I think, is an important one because it's a relative term. Nothing's really ever safe, right? It's hopefully you can outperform in magnitude enough such that the relative outperformance results in absolute returns, but it's okay if you're down a lot less than risk your assets in a dislocation. So the question becomes, if you're going to position defensively, what are your options, right? You mentioned gold, you mentioned treasuries. I think it's true that gold has been a beneficiary of scared money for the last several months. And I say that very purposely because big money does not short the market, the stock market. Big money, from an asset allocation perspective, tries to get bearish on the stock market by lowering correlation, by putting a mix of asset classes together in a portfolio that are really not correlated to each other. You want correlation when things are going up. You don't want correlation when things are going down. Gold is one of the few things which behaviorally is largely uncorrelated to the stock market. So I do think that what we've seen in this gold move is institutional rotational defensive posturing. The thing is, and I think a large part of that also is because normally those institutions would go to longer duration treasuries, and as we know, that's still challenged until it's not, right? Gold, though, as a market, I don't think is big enough to absorb a real flight to safety moment. I mean, if you have a real global dislocation, yeah, I'm sure gold would probably still benefit, but it would not benefit, I think, to the same extent as treasuries, because treasuries would have that liquidity, right? So I think it's sort of a question of, if you are somewhat scared of the market, you position to gold. If you're really scared about the market, it's still going to be treasuries.
Okay. So we just had CrowdStrike bring the world to its knees by taking down a lot of the world's technology and computers in the largest cyber outage in history. Many are asking why there was no redundancy to prevent this even from happening in the first place. That said, this incident really showed what's possible and how paralyzing it can be. You had posted the morning of the outage, in the end, it won't be war that brings the world to its knees. It'll be code. And today is just a preview. Do you see this as a dry run for what could possibly come in the form of the world's most damaging cyber attack? And if it does happen, in your analysis, what level of impact are we talking here?
I think, okay, let's go back to complacency. People seem to be of the mindset that we're in an age of precision because we're in an age of technology. But the reality is technology can result in very unexpected outputs. And I say that as somebody who actually went through the process of developing my own app and seeing how bugs come out of nowhere. Things that seemingly were caught by the quality assurance side of things, they fix one bug and then another bug comes up. And in the world of coding, one small thing can disrupt the entire application, right? Which looks like it was what's the case with CrowdStrike. I think it's a reminder that people have to be very careful what they wish for when it comes to integrating technology in every single aspect of their lives. Because technology, by its very nature, is winner take all, which means it's concentrated in power, right? And that is a concentration risk, which can have all kinds of systemic dynamics play out in a negative way. I think it's interesting that when the CrowdStrike dynamic happened, the cryptocurrency space did quite well, Bitcoin in particular, which was almost like a vote for decentralization, right? In the currency, in the crypto end of the world. Are we going to see more of that? I have zero doubt, right? I mean, whether it's from a hacker or just sloppiness, or not even sloppiness, it's just something happening that disrupts, the output of code. You're going to see more of this. And with AI, believe me, it's going to get only worse. I don't believe the argument at all that AI will make this stuff better. Anybody that's ever spent any time with AI and output knows that it is tremendously prone to error in terms of what you are seeing from the large language models. And you're never going to fully get rid of that.
So a world that's filled with increasing outages and volatility challenges because of an increased reliance on technology.
Yeah, I think it results in more vulnerability, more fragility, right? Because again, I go back to, if everything is about technology, well, if everything's about technology in every single part of our world, then you're only talking a select number of mega cap tech companies, which are running the whole show. So suddenly, one vulnerability in CrowdStrike impacts airplanes flying, impacts Microsoft services. It's like, there are a lot of benefits to technology. I'm not a Luddite by any means. I'm just suggesting that there is a risk, and it's very real, that you could get butterfly effects that take the form of digits of zeros and ones in code that can have all kinds of nasty ramifications. Now, thankfully, it didn't result in, at least from what I've seen, any deaths or anything really serious beyond a momentary disruption. But that could still be coming, and that's the unfortunate reality of our future.
And to your point, as the technology capabilities compress into just a few, the risks actually compress and they increase as that compression happens. So I wanted to ask you about treasuries here in particular. There's a massive wall of treasuries. Some report as much as 9 trillion that's maturing over the next 18 months or so that'll need to be rolled over, plus the historic deficits of 2 to 3 trillion annually and rising. First, are there enough buyers for all this issuance? And second, if not, the Fed's going to have to monetize quite a bit of it. So what are the ramifications to rates, the economy, and the markets in that scenario?
You can always create buyers, right? I mean, really, you always create buyers. And what I mean by that is if you have enough fear in the stock market, you'll create buyers because people say, I don't want the stock market, I want treasuries. Because at least it's not volatile or it's backed by the U.S. government. It's like I've used that line before. It's like to save treasuries, you have to crash stocks because historically when the stock market goes down heavy, it creates that bid, at least for a moment in time, to absorb some of that supply on the treasury side. Now, it is true that no matter what one's political views are, debt's only going to go up higher. Right? Doesn't matter if it's Trump or Kamala or Kennedy or some alien that suddenly decides to run for president that was born in the United States, and I mean actual alien from out of this world, and as far as the parents go, like it doesn't matter, right? The end result is you're going to have more debt, and the interest expenses only go higher. If we accept that that's a fact of our present life, then what is the implication? The implication is the U.S. government's going to need perpetually, as historically is the case, negative real interest rates, meaning inflation being higher than the cost of capital, than nominal rates, right? Because that's the only way you can erode the debt load is if inflation's eating away at it faster than what you're spending on the interest to service it. So oddly enough, that would argue that you're going to have lower rates, right, and more elevated inflation. And we're going to probably see what we always see, which is they'll find a way, they, in quotes, the powers that be will find ways of recalculating how inflation is calculated to make it look like it's 2.5%, when in reality it's probably a lot higher. I mean, they've played this game before on these calculations.
Yeah, I mean, in the 70s, I'm pretty sure my memory is correct. The purchasing power of the dollar dropped by about 80% during that decade, to your point. So,
yeah, and it's,
Michael,
and it's not going to stop.
Consumers are levered up to their eyeballs. The strong labor market seemingly has been the main thing that's been holding up the economy. The yield curve is now uninverting, and unemployment is rising, now up to about 4.1%. And that's if we accept all the numbers that were being given as factual. Where do you see unemployment going in this cycle, and what damage will higher unemployment have on the economy at large?
It's a good question, and I don't have a particular strong view on it, but what I will say is that I think a large part of that answer will depend upon who is president and immigration policies as a result. Because I do think the unemployment rate has been skewed by just the sheer amount of immigration that's happened. So it looks the way it looks, probably because of more of a distortion in terms of how the calculations are being made based on the immigration side. But it's true that the unemployment rate does look like it wants to keep rising. Now, you can argue that that's long overdue. We just went through the fastest rate hike cycle in history. And I keep flagging small caps not really performing very well at all. Small caps, which are more sensitive to the domestic consumer. Small caps have been telling you that the labor market should be weakening for a while because how else can you explain small caps going sideways? Right? There's concerns around debt, around razor thin margins, which means, of course, they have to at some point lay off people to be able to pay off their liabilities. So, I don't have a sense of sort of how high it could go. I do have a sense that the momentum is actually building, and I'm not convinced the Fed can necessarily get ahead of it.
Yeah, it does feel that way. So speaking of the Fed, ex-New York Fed Bill Dudley, he came out and has done a 360 and said it's time to cut rates and cut them now. Do you see the Fed getting caught off sides on this like they did in inflation in 21 and 22, which forced them to implement unusually large rate hikes at that time? Do you see them being off sides again to the point where now they have to, at some point, probably after the election, implement unusually large rate cuts? And how low do you expect them to take the cuts in this cycle?
So to be clear, more often than not, the Fed is late, right? They react. They don't really anticipate. This is a kind of a tricky juncture in the sense that, on the one hand, you can argue it's been justified for the Fed to not cut rates because credit spreads have been very tight. Differential between junk and AAA has been narrow. The Fed really worries about default risk. The bond market itself has said there's no real default risk, so you don't have to worry about flushing the system with liquidity in a traditional sense. On the other hand, you have the disconnected message of small caps, which are clearly telling you something's off. It's like, why else have they not participated in this rally? Because a rising tide is not lifting all boats. Why is that not happening? Because something's wrong in the way the system is operating. So I think it's hard to sort of say the Fed is going to be late or early this time, because I think they're taking their cues off of the credit spread bond market side of things for what happens next to monetary policy, which may end up actually being the wrong thing to take your cues off of. It may very well be that small caps have been the real warning sign all along, which is why they should have lowered rates earlier.
So that's interesting. So there's many experts and analysts who are now very troubled by the recent economic data that's coming out. Are you seeing danger signs in the data that have you concerned, similar to the level of concern many had pre-2008 and even pre-2000? And if so, would you elaborate on that?
I mean, the big thing is that it's clear that delinquencies are rising. I mean, you can see it in a lot of the data. They're not rising at a level where you'd say it's cataclysmically dangerous, right? But again, it is accelerating. And again, it shouldn't be a surprise because, all this revolving credit at, 25% average credit card rate or whatever it is now, it's like at some point that has to factor into cash flow and just the ability to keep paying off bills.
You would think.
Now, typically it happens on the lower end first, right, of the class structure, right? Which makes sense. The less money you have, the more this puts a strain on you. But it is starting to impact and kind of move up the chain in that sense. So I don't think it's to the same extent as those prior crises, but it doesn't need to be, right? When you're in a very leveraged system, it doesn't take much for things to go haywire. I still maintain this idea that, and I've been wrong on this so far, that Japan is a much bigger risk than people realize when it comes to global leverage and reverse carry trade and all these things I've talked about ad nauseum. But yeah, I do think it's clear that consumers are struggling. There was a Gallup poll about a month ago where in the poll, the turns out that the respondents thought 3 out of 5 respondents thought we were in a recession right now. Why is that? Because if you're going to only pay off your credit card interest expense and just do minimum payments, you feel like it's a recession, right? I mean, it's just the truth. So I don't think all is well behind the scenes. Again, it doesn't mean that you have to have something cataclysmic, but it's a strain.
So are you personally in the recession is imminent camp? And if so, why?
Look, I think you alluded to it. If the uninversion is here, history would suggest this is when you probably would have a recession, right? Now, it'll be interesting because if we are due for a recession end of year or start of next year, the stock market should start to respond negatively around now. All right. So in other words, if you were to start seeing the stock market really go through a volatility juncture that persists, let's say the S&P 500 gives back all of its gains for the year, which sounds impossible, but it's happened plenty of times, right, in the second half. That would probably mean the market itself is betting that recession's here, that the uninversion is the signal everyone's been waiting for is actually flashing, finally. But we'll see. I mean, so many things are so off post-COVID. There's no other way to say it, right? There's so many weird dynamics where it's hard to really have any confidence in a lot of the macro prognostications now.
Let's talk about that volatility for a moment, though. Volatility seems to have been removed from the markets the last year plus. However, it had been ticking up lately, and I think today it's up almost 15%. Is there a number that the volatility index would have to reach before market participants would recognize and say, this level is likely where panic and a pullback would set in?
Yeah. So the average VIX level is around 20, right, historically. So the thing is, every time you've kind of crossed above 20, it's gotten knocked back down. So I think what you'd really need to see is the VIX, go to like maybe 23, 24, 25 and stay there for an extended period to then become a self-fulfilling sell cycle. Right now, there's almost this Pavlovian response. The VIX spikes up. That's when you buy equities and VIX gets crushed, right? You need something to kind of break that mentality. And oftentimes the only way to break a behavior is just through repetition, which means time where it stays elevated. So yes, I do think that we are due for a VIX spike. That's not me being a perma-bear. That's just me factually saying, high volatility tends to be preceded by low volatility and complacency until the event.
Yeah. So you recently posted, I've been bullish on value over growth, but value as a style outside of sector tilts can be a bit subjective. Would you speak into your statement for us?
Okay, so we should define what value basically means anything but tech. I mean, that's kind of where we're at now as far as the distinction of growth versus value style investing. Tech is the quintessential growth sector. When you look at value, you're talking about financials, industrials, consumer discretionary. From a sector perspective. Now, when I say it can be subjective, I'm talking more about, everyone has a different favorite fundamental ratio or relationship that they look at: PE, price to book, earnings growth, whatever it is, right? But broadly speaking, those sectors tend to be pretty persistent across the board. Now, if we couch it under the framework of value is anything but tech, then it makes a lot of sense as to why the U.S. market has outperformed everything else. Because the U.S. equity market is largely tech, whereas anything international is largely not, right? It's largely financials, value, largely materials, energy, industrials, discretionary value. So when I say I think there's going to be a shift, which may already be underway now, of growth relative to value, it basically means it's a shift away from tech into other parts of the marketplace. Now, the thing is, arguing that there's a rotation in sectors is not the same as arguing that you're in an uptrend. It's a relative movement type of dynamic, right? So you can have money rotate away from tech into other areas of the marketplace, but still in a declining market, right? In 2 out of the last 3 times where value outperformed growth, there were bear markets. Maybe it's not going to be the case if this is the 4th time, right? And it becomes 3 out of 4. But, I think it's hard to imagine a scenario where markets can rally outside of tech, where value is what leads the market from an absolute basis higher, purely because the earnings are just not there for a lot of these value stocks, whereas it's been there for tech despite the overvaluation.
So staying on the market theme, Michael, is today's market propped up by an unrealistic or otherworldly narrative around an AI-driven future, and one where the dominant, above all others in the world, that will benefit the most is NVIDIA? And if so, what actually happens when that narrative is found out by the masses to only be a narrative?
So to be clear, I'm not. It's not that I'm negative on AI. I'm a negative on the time frames, right? I mean, it's like AI could end up being, it's not even clear if what's happening is real AI, right? I mean, it's as opposed to correlation of words when it comes to large language models. I mean, that's a whole different discussion. But I think in general, what's really driven the AI trade is leverage, along with a sexy narrative and story. It's like I put out that post a little bit earlier. The yen bottomed and NVIDIA topped. If you understand this, unless you understand the carry trade, right? Because to the extent that you've had the ability to leverage cheaply in certain parts of the globe and then allocate that cheap leverage into AI stocks because that's where the momentum is, it becomes a self-fulfilling momentum cycle that's not being driven by anything except greed, right? Yeah, sure, strong earnings, but not to the same extent of the PE multiple. So when there is a realization at some point, like is always the case, these hot areas will overcorrect, because that's how mean reversion works. You have to go past the mean, right, for that to take place. Yeah. It's not a bad thing. And by the way, that's not a criticism on NVIDIA and its success. It's the madness of the crowd is what you're betting on, not on on AI.
So let's combine the last 2 pieces of our conversation between AI and this sector rotation. So, Michael, NVIDIA has a $3 trillion market plus market cap. What happens when this cycle is over and a percentage of that market cap rotates out of NVIDIA and other AI investments and into sectors such as commodities, gold, silver, miners, things that we need for the next cycle? Those sectors, they're so small in comparison.
Yep.
What do you expect to happen there? Or are you not anticipating a rotation into those sectors? Or are you expecting it to go somewhere else? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com and put in your email address to subscribe and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video.